it was such a rude awakening to just how discriminatory the entire market is, just how inefficient it was. And, as I started learning more about, crypto, blockchain, everything, you realized, wait a minute, this is the answer to all of this stuff. So I guess I jokingly said, I got myself in a little trouble. I jokingly said the first time I was asked this sort of question was like, I realized I was just at the top of the pyramid scheme. I didn't realize that. I realized that the entire financial system and the entire banking world was really one big Ponzi scheme.
Other exciting features that you're working on?
Yeah,
natively from the $5 UI.
So look, we added staking with you amongst others, and there's I think a lot more on the staking side that will be coming from Fireblocks, especially as we look at other assets, thinking around in DeFi and how we could provide not just staking and not just swaps, but there's probably more there.
Alrighty, everybody, what is going on? Welcome back to another CYPRX video banger. In today's video breakdown, we're going to continue to dive down the rabbit hole, show you all undeniable, documented proof that financial institutions are not just buying and hodling these digital assets, they are actively participating in yield generation strategies because they know the massive long-term potential of holding these digital assets long-term, accumulating and compounding yield that they're earning while participating in this digital asset ecosystem. As always, many blessings to you guys. If you enjoyed today's video breakdown, showing you guys these fundamentals that prove that financial institutions are not only onboarding in this space, but actively earning and participating in the DeFi ecosystem, do me a favor, smash that thumbs up button and subscribe. So the reason why we are consistently showing you guys this evidence is because there is this massive misunderstanding about DeFi that currently exists in the space, where people are still living in 2022, thinking that the DeFi ecosystem has not matured, that it's not safe, and that it's still a scam. That is the farthest thing from the truth. This is the SVP of corporate development and partnerships and the CEO of Fireblocks Trust Company, who literally just said that they're integrating staking services into their core infrastructure. He mentioned digital assets like Aptos, Soy, and Solana, all whom in which right now you can go and earn passive rewards by participating in staking.
The other aspect that we're spending a lot of time is you think about stablecoins and you think about tokenization, but you layer that in with the variety of protocols that are out there. And we can make the argument about why you should stick with EVM or why EVM is no longer the best. And there's options like Solana or newer players like Sui and Aptos. But the better approach is thinking about interoperability. And so Fireblocks is working with others in the market, and announcements coming out hopefully soon that will explain how, when you're tokenizing an asset, think natively day one when you tokenize it, how to work with the right protocol so that your tokenized asset has that interoperability capability.
All right. And so if we come over here, we'll come back to that gentleman in just a second, but I want to dive down the fundamental rabbit hole and show you guys that here at CYPRX, we are tapped in to what large organizations like Fireblocks are talking about. This is from the other day, May 9th, 2025, where I said to you guys, seeing prices pump in crypto is exciting, no doubt. But watching those same assets surge while you are also stacking passive yield on them, that is when you realize that you are no longer just an investor, you've become your own bank. There is an entire other side of the game where price action meets smart positioning combined with daily yield generation. And down at the bottom, I tagged XLR, whom is a partner of Fireblocks, Aptos, Say, Solana, Algo, Soy, Flare, Bitcoin, and Ethereum, all assets which right now you can go and you can participate in yield generation strategies. Again, not financial advice, but could you imagine holding a basket of assets between now and 2030 and earning no rewards, no passive income, or instead reposition your mindset and think long-term hodl while at the same time earning passive rewards every single second of every single day, compounding those yield rewards up until 2030 and beyond. You are going to supersede the vast majority of the population that is invested and involved in crypto instead of thinking I'm going to sell for fiat currencies at some high-end price.
That the entire financial system and the entire banking world was really one big Ponzi scheme.
All of the fiat money in the world is depreciating. Some a little bit and some faster. And if you count all the fiat money and you calculate the depreciation that they have, it's a gigantic value.
If we come over here Here is a report that just was posted from Signum Bank 3 days ago. As of time of recording, it is the 19th of May. So depending on when you're watching this, this is relatively fresh. And if we come over here, check this out. This is undeniable proof that large financial institutions and banks in this space are not only offering these services to their clients, but that DeFi and earning yield adds an extra layer of utility to these digital assets.
DeFi actually brought utility to ETH, right? Now, if you're holding ETH, you can lend it, you can borrow, you can stake, you can do so many things.
And that is something that we've conveyed to you guys in previous video breakdowns, especially surrounding the digital asset XRP, where yield generation strategies have been all but non-existent over the past consecutive couple of years for XRP holders. That is all about the change, and DeFi in itself, yield generation strategies and the ability to take your idle XRP and turn it into a yield-bearing asset is going to bring its own level of demand and utility to said digital assets, specifically talking about XRP, but for digital assets across the board. So this announcement just came in the 15th of May, 2025. And it reads, Signum, a global digital asset banking group, today announced the expansion of its credit offerings by adding staked Solana as an eligible collateral for its Swiss franc, Euro, Singapore dollar, and US dollar denominated Lombard loans. This allows Signum clients to unlock liquidity from their staked Solana holdings while continuing to earn staking rewards, creating dual income potential from a single crypto asset. That is a huge statement, creating dual income potential from a single crypto asset. Additionally, Lombard loans that pledge staked Solana as collateral are low cost because they generate staking rewards and are used to cover the majority of fees. By enabling staked Solana as collateral, we are addressing a key client need to optimize yield while maintaining liquidity, said Benedict Kodau, head of credit and lending at Signum Bank. This enhancement builds on our proven track record in crypto-backed lending, recently demonstrated by our USD $50 million Bitcoin-backed syndicate loan to lend last August. Alongside Solana's collateral functionality, Signum Solana staking service enables clients to generate staking rewards on their Solana holdings through the bank's institutional-grade custody and staking platform. So for anybody out there that thinks that a portion of DeFi is not regulated, they're not doing enough research and they're lying to you all. Again, make sure that you're tapping into the proper research, the proper fundamentals, and the ongoing developments that are taking place in this space so that you don't risk falling behind, not only in terms of your education, but in terms of the opportunities that you now have at your disposal as a retail investor. It goes on to read, as the second largest staking token by staked market capitalization, adding Solana stake capabilities was a natural evolution. Do you all see that right there? What have we told you guys in previous video breakdowns? That staking is going to become the new normal. Everybody is going to be staking and participating in yield generation strategies. This is a natural evolution of our offering. Combined with our Lombard loan functionality, clients can now maximize the utility of their Solana holdings. This is epic. As I've mentioned to you all in previous fundamental video breakdowns, we are entering into an era where a certain portion of our digital assets we are not going to have to sell. Now, heading over here to a panel discussion, listening to a gentleman mention that, you know, a portion of our digital assets we're not going to have to sell. You're not going to have to sell out of this space, reposition yourself back in at a discount and continue that cycle. Instead, you can just go start to participate in yield generation strategies. He's sitting on stage with Robbie Mitchnick from BlackRock and Christine Moy from Apollo, whom in which we've played video breakdowns before in previous videos. Listen to what he says here about not having to leave crypto and instead just participate in yield generation strategies during market downturns.
Yeah, I mean, I think the main thing we've seen is in general, if I take a sort of like historical lens of crypto cycles, you have a sort of ebullient sort of bubble / high growth cycle, followed by sort of generally the sort of bear cycle where people are generally trying to preserve assets rather than kind of invest in new assets. And what you have at each cycle is sort of this kind of money multiplier kind of effect where like you start at 10, imagine you started before one cycle, there's $10 of new capital. At the peak of the bubble, there's maybe sort of $1,000 of levered capital that's in the system. At the end, in the bear cycle, there's maybe around $100. So sort of the crypto general stable capital has grown over time. And if you look at each cycle, what has caused the kind of net retention of capital at each cycle? It's usually some technological innovation. So after the ICO boom, you saw a huge growth in stablecoins, especially in USDT and USDC. And then after DeFi summer, you saw a huge growth in money markets and people actually leaving things in on-chain yield. And I think effectively what we're seeing now is the RWAs are providing a reason for you to not leave the chain. You maybe went on chain, made some money, maybe you traded meme coins, but then now in past cycles, you might have said, okay, I'm going to take my money off and go back to US equities. But now you actually don't have to leave. And I think this notion of this retention effect being much more enabled by each new wave of assets is really important. And to have that keep growing, you need to have composability and you need to have a way of being able to offer yield even through the down cycles. And RWAs act as a sort of counter-cyclic instrument that provides that yield during those times.
That's an important.
You need to have the ability to provide yield generation strategies, and now investors don't have to leave the market. That is huge. Do you know how much pent-up demand that is going to create once financial institutions come on board? And yet again, I have more physical proof that financial institutions are interested in this. So if we head back over here to the gentleman from Fireblocks, listen to what he says about institutions being interested in participating in staking.
On the other side, the VCs, some of them are investing more blue chip assets, your Bitcoin, your Ethereum. They're looking to stake the Ethereum. But many of them are investing in a wide variety of assets. And when they come to us, they're saying, look, the Fireblocks on the wallet side, we know supports it. Can the custodian do it? And by and large, the answer is going to be yes. So there's many out there with competing of whose list is longer of asset support. That's not the game we're looking to play. Really focusing on client demand, especially with these design partners. We're talking to them about which assets they want. And some of them are top 10 assets and some are numbered like 175 on the market cap list, but that's what's important to them.
So I just wanted you all to hear that. It's not just their interest in ETH staking. They're interested in top 10 assets. And he even mentioned number 175, whom I don't know what asset that is off the top of my head, but it just goes to show that these institutions are interested in multiple digital assets, and they are for a fact interested in earning yield. This is huge confirmation. So if you're not participating in DeFi yield generation strategies, ask yourself, why not? Is it because you're skeptical? Is it because you don't know how? Is it because you don't want to take the risk? At the end of the day, start learning, start educating yourself, and start seeing the long-term vision that we now are operating on a level playing field with these financial institutions where we can participate in yield generation strategies with these same digital assets that most of us, I presume, are expecting to hold until 2030 and beyond. I don't know why you would be participating in crypto if you're just looking to sell back into fiat next year or whenever the market pumps next. That's weird to me, but to each his own. Anyways, moving on. This is another post just to show you guys more undeniable proof. I put this out to you all on May 17, 2025. And I said here, a massive USD $84 trillion wealth transformation from baby boomers to millennials and Gen X by 2045 is underway, and people are still not paying attention. Earn yield on your digital assets, compound and repeat the process, sit tight for the long term. It's honestly simple. I could not imagine next year if the market pumps to $5 trillion, selling out of my positions, trying strategically to reposition myself in some speculative market pullback, if we even get one, to buy more. Instead, I would rather just delegate a portion of my digital asset portfolio, not all, but a portion that I'm willing to risk, to the DeFi ecosystem and generate passive rewards, taking those passive rewards every single day, recompounding them back into my portfolio, and just continuing to stack. So you go from just a hodl mindset to a hodl, stack, compound, earn, and recycle that process mindset. It offers huge opportunity growth in your portfolio. So check this out. This is a document from Baker McKenzie and Deutsche Bank titled Tokenization of Financial Markets, Mapping the Plausible Future Through Scenario Analysis. Here is where it talks about the great wealth transfer. It says a massive USD $84 trillion wealth transfer from, again, baby boomers to millennials and Gen X by 2045 is underway.
And this is the third aspect that I want to talk about, which is the greatest wealth transfer in history. And what I'd like you all to think about is, what is that number? And I'm going to tell you that number in a second. What is the number that the silent generation and baby boomers actually have in terms of wealth? And I will tell you that it's the largest that has ever been held in history. And that number is $100 trillion. It is a huge amount. Now, the reality is that over the next 20 years, circa 85 trillion is going to be transferred. So this is the largest intergenerational wealth transfer we will see in history.
Millennials are 5 times more likely than baby boomers to own crypto and digital assets. The next generation is digitally native with a strong affinity for blockchain-based financial products, creating a conducive environment for a shift from traditional asset classes to non-traditional asset classes, including crypto and digital assets. This is huge confirmation that a massive shift is underway. And in their document, what are they talking about? New digital assets, tokenized bonds, composable funds attract retail and institutional investors with transparent pricing, lower fees, round-the-clock trading, and higher yield. And then right here, it mentions DeFi concepts, including staking and automating market makers, are being brought into the traditional financial ecosystem. There is a growing desire to collateralize crypto and other digital assets to free up liquidity to invest into income-generating investments with capital appreciation potential. Do you see that highlight right there? This document, by the way, is from the beginning of the year, and I just showed you guys a fundamental piece where this is for a fact coming into fruition. Signum Bank is offering this ability right now. It literally says this allows Signum clients to unlock liquidity from their staked Solana holdings while continuing to earn staking rewards, creating dual income potential from a single crypto asset. Ladies and gentlemen, if you've made it this far, smash that thumbs up button and subscribe. This is undeniable proof that the documents that we are providing for you guys here at CYPRX are for a fact coming into fruition, and you should not be denying them. You should not do yourself a disservice and ignore your education, and instead further your insights into these markets, tap into a private community like ours here at CYPRX, or follow the free content on YouTube and on X to stay tapped into what is actually happening. This is a massive development and confirmation that this is for a fact happening. Moving on. Couple more fundamental pieces for you guys. I said here, institutions are not just buying crypto anymore. They're earning yield on it securely, legally, and at scale. I even dropped the document to this fundamental piece where Securitize back in April 2025 launched this Mantle institutional crypto fund, where it unlocks secure yield-enhanced exposure to a diversified basket of digital assets, including Bitcoin, Ethereum, and Solana via a regulated tokenized fund structure. I'm not going to dive too much into detail on this one, but it mentions that it allows dynamically weighted and integrated yield strategies, right? This is, again, huge confirmation. Since we're on the topic of Securitize, and that's who put this fundamental piece out, we'll go to a more recent development. This is from Securitize's LinkedIn profile, posted just 3 days ago, and it says, "The future of finance is composable, and now so is the BlackRock USD Institutional Digital Liquidity Fund. SBIDL, minted from the BIDL Fund via Securitize's Token Vault technology, is now integrated with Euler Finance on Avalanche." So what does this unlock? I will wrap it up here. It says, with SBIDL on Euler, users can borrow USDC, USDT, and AUSD, DUSD. They can access liquidity without selling yield-bearing BIDL. Do you guys see that terminology right there? We're not making this up here at CYPRX. We're not saying, hey, we're entering into a future where you're not going to have to sell your digital assets because we're just waking up and making this stuff up. No, this is coming directly from financial institutions. It also offers DeFi composability across Avalanche, and users can earn AVAX rewards by borrowing USDC or AUSD using SBIDL as collateral. This unlocks a new era of utility for tokenized real-world assets. This is yet again another huge DeFi primitive that is taking place in the space right now, unlocking DeFi utility from BIDL with SBIDL, where investors can unlock liquidity while earning yield. If you guys see that right there, right? This is the little infographic that they have. So to wrap this all up in a nutshell, showing you guys undeniable proof that this is taking place, you should not be ignoring your education in the DeFi ecosystem on the space, learning how to turn your idle digital assets to yield generation assets, participating in yield strategies. As always, if you guys want to see how we are earning passive rewards on our digital assets, you can always head over to CYPRXtrading.com, tap into the Wealth 28 Club. We'd love to have you on the team. And if not, just make sure that you subscribe to the YouTube. Check out the yield playlist on the CYPRX YouTube. There's like 60 videos in there that go over this stuff in detail. Don't ignore your education. We're witnessing a massive transformation, not only of the financial ecosystem, but of wealth in general. And you do not want to be left behind, leaving rewards on the table that you could have participated in over the next consecutive couple of years while we're just hodling, buckling down, and continuing to stack via the long-term perspective. As always, Many blessings to you guys. None of this is financial advice. Always go out and do your own personal research. And with that being said, I'll see you all in the next video breakdown.